So good morning, everyone. I think Jaideep gave a very good roundup of what's happening in this industry. And I was told to talk a little bit about how to de-risk the NBFC model. So I'll talk a little bit about it. And some of those things are relevant from today's environment, and some of them are relevant trying to prepare in case we face another such cycle. But just going back a little bit in time, and some of you who are, my age or slightly younger, Sridhar is there, Sumit is younger, but some of you have seen business cycles. This is not the first, downturn which we are seeing. At least I am seeing this as the third one. The first one happened in 90s. Where NBFCs went through a very difficult time, and that lasted for a very long period of time. We saw the demise of a lot of NBFCs. But the good part was a lot of them came back stronger and did extremely well in the following decade. We saw some problems happening in the global financial crisis of 2008-9. That's when, some of the challenges came up for this industry too. But that cycle of downturn didn't last very long. While there was pain, the cycle period was not long. The 90s cycle period was pretty long. And now we are facing another challenge. So it seems to be coming back once in a decade. This current cycle has been there now for close to about a year. We're just going to, I don't know, we call it celebrate the anniversary of the challenging event which happened. And the way I look at it, some bit of this pain will be there for some more period of time. So I don't expect to be as long as the 90s, but it's not been as short as what we saw in the previous decade. The good point in all of these has been the fact that each time the companies came back stronger and the next decade actually belonged to them. They did fairly well. Let me say they did much better than the other players in the financial services industry. And I think this down cycle will also produce the same. I'm pretty positive about this sector. Because, all of what we speak about when we talk about the good times in the Indian financial services industry, about the demographics, rising income, more employment, if you leave aside what's happening in the short run, I think so all of those things remain as they were before the last October, and there's no reason why that will change in the next few decades at least. So, the basic fundamentals remain strong. I think what is more important is how do we manage the current times, and two, how do we always be prepared to handle in case the next cycle comes. And there's nothing like in case. I'm pretty sure the next cycle will also come. But if we learn from the past cycles and the current cycle and are prepared for the next one, then probably we will see lesser pain. And that is what I'm going to talk about. This is probably the only gloomy slide which I have in the presentation, but it's just to talk about what's happened in the last and these are last few months. All these headlines have been there in the last 2 months about this sector. But in what we are seeing, as we saw in all other down cycles, that if you are well capitalized, if your portfolio is good and governance standards are good, you will tide over this cycle. Don't worry about growth rates. Growth rates may moderate for a year or two, but we are not here for the short run. We are there for the long run. So all of these things can be managed. What is more important is for the entity to ensure that they manage these times. And when I talk about well capitalized and so on, I'm not relating it to size. I'm seeing a lot of smaller companies also who are managing this cycle fairly well because they are well capitalized, their portfolio quality is good, and people trust the management. So it's not about size, but it's about the basic fundamentals which I'm sure investors look at when they put money into these entities. Just one slide which has numbers, but again, if you look at what has happened in the last 1 year, there have been, if you look at NBFCs vis-a-vis the industry, they've done well even in the last 1 year. Obviously, there was some amount of good part of the first half year of last year. But still, if you look at it, the growth rates have not been bad. And there are certain sectors where NBFCs continue to do well. When we talk about NBFCs, we always talk about how they've created a niche for themselves. You know, there are products in which they do better than the banks and other competing players in the industry. We've talked about how they have spread out more deep into the market. We've talked about how, you know, they have partnered with fintechs much more to create new business opportunities. There's another area in which NBFCs continue to do extremely well is to get more, you know, customers within the credit system. So if you look at the new to credit customers, NBFCs have got close to about 56% of the customers compared to all players in the industry. So they've been the entities who have looked at data, both formal and informal, and got more customers within the credit space than any other player or any other segment within the industry. Talking about a little bit about how do we manage the current, how do we prepare ourselves during this period, and how do we look at the future so that we are well prepared to take advantage of growth when it comes back. You know, why this, some of these things change. It was not only the IL&FS crisis which led to this change, but there are a number of other factors which led to this change. For example, you know, when you look at the period before that, we saw interest rates coming down. We had seen a decade of interest rates, a period where interest rates were only coming down. So even if you did business at competitive rates, you would find you would still make money and your NIMs will be high, because by the time, you know, your portfolio becomes a year old, interest rates have further fallen. You also saw surplus liquidity, abundance of liquidity being available. We also saw asset prices growing. So like people who are there in the real estate industry, you know, even if you lent at a 75% or a 90% LTV, within a year, you found that those LTVs were 60% or so. So asset prices were growing. You could lend on the same assets also, as well as the fact that even if you had been aggressive on lending on LTVs, the LTVs appeared to be lower after a year because the asset prices had grown. Plus the economy was growing. We saw a period, a decade where economy was growing at 7.5 to 8.5%. So everything seemed to be right. And suddenly after this period, we saw interest rates moving up. So even if you felt your margins were okay, suddenly you found those margins getting squeezed. You found money was not as easily available. So if you had taken short-term money and wanted to refinance, it became difficult. You saw asset prices coming down. So, you know, when we had in the past decade seen real estate prices going up year after year, here we saw real estate pricing coming down every year. So if you ever repossessed an asset under SARFAESI and wanted to recover the principal, you found it difficult to recover the principal too. So, plus the fact that growth rates slowed down. So you saw the GDP growth rate coming down, the credit market growing at a lower pace. So all of which seemed to have a tailwind, suddenly you saw that business facing a lot of headwinds. So you know, a lot of players were not prepared to handle this. And let me say, this also happened pretty suddenly. In a very short period of time, you saw the cycle turning. And that is what probably, according to me, really made the problem even more difficult. but as we said, the opportunity is large. And so what do we do, and how do we manage such situations, both in the current environment, and how do we ensure that we are well prepared for the next cycle when it hits us? So just few points on these. The fact that how do you manage your capital structure, how do you manage your ALM, how do you ensure your governance and compliance standards are up there, how do you reimagine business, how do you create a business model which can handle these challenges in a far better manner, how do you ensure that your book quality remains pristine and people who are looking at investing in the company feel very confident about the portfolio which one has created. And why I say this is, our lending business is unlike any other business in the industry. In our business, when you sell a car or when you sell a consumer durable, you come to know how much money you've made. We as lenders come to know how much money we have made only when the 31st to 36th installment is paid. So we don't come to know whether we have made money or not in the first 30 months. We come to know only in the last 6 months whether we have made money or not. So our business is different. So having a portfolio quality which is good, which will stand out in the long run, is extremely important. And fifth, which I feel is becoming extremely important today, which is not only about debt management, but it's about, are we putting more resources in areas which will actually be the areas which will turn the fortune for the company. So a lot of times, resource allocation within the organization is not also appropriate. But we have to ensure that we are up there on that so that we can manage any adversity. I think a lot of us know about this, so I won't spend much time. But the fact is this, that we have seen both types of players. People who are well capitalized. By well capitalized, I mean that they had capital which will help them for growing for the next 3 years without raising fresh capital. And there were players who were raising capital every year. The ones which were raising it every year felt that it's better to do that because then you can raise your capital every year at a better price, so you get diluted lesser. So I feel, especially in our industry, when you can't predict when the cycles will come in, being there for and having capital for growth for the next 2 to 3 years is extremely important at any point of time. Timing of the raise, I think, so we've all learned, you don't raise money when you need, but you raise it when you can get it at the right price. So even if you have to carry more capital at any point of time, that is more relevant than just raising it at the time when you need it. The importance of having the right investors is extremely important because we've seen this in this industry. So if you have a set of investors who own stake in the company which does not move, it supports your price much better than what it does in any other scenario. Resource diversification, and this is something which we have seen in the last 1 year or so, especially for NBFCs, while there were some players who saw an increase in bank lending happening to them, there were players who were squeezed on bank liquidity or mutual fund liquidity. And we saw a lot more new avenues open up. For example, ECBs seem to be, the flavor of the season. A lot of people are raising money through that. Public NCDs, a lot of people are raising money through public NCDs, and especially with the current changes in regulation where DRR has been taken away, that opens up another opportunity. A lot of players who have a fixed deposit license have suddenly upped the game on raising money through public deposits. So you are seeing resource diversification happening across the industry. But why I wanted to mention this is, especially at any point, looking at the industry we are in, we have to be prepared to raise money through any means at all points of time. Because you don't know which gate will close or which gate will become much more convenient to, raise money. So be prepared at any points of time. For example, are you rated internationally? Are you prepared to do a public issuance of bonds? So, we have to be prepared at all points of time, because the market is becoming pretty volatile and there could be pockets of opportunity, and we should be there at that point of time to take advantage of that opportunity or that pocket of opportunity. Interest rate risk, that's another ball game on its own. How your assets are priced, how your liabilities are priced, do you hedge, do you not hedge, and so on and so forth. But one needs to manage the interest rate risk too. There are other opportunities which have been opened up where people can work closely with other lenders, especially banks, which seem to have surplus liquidity at this point of time in terms of securitization and co-lending. I feel here also each NBFC should be there, whether they want to securitize or not, they should have a portfolio there, because you never know when you want to create a market for yourself, at what time you want to create a market for yourself. So you have to be prepared, you have to have that experience, you have to have a set of people who will be willing to buy portfolio from you at any point of time. Similarly, co-lending, whether you want to do it or not, be prepared and have the agreements and the systems to do it. Now, whether you want to push the button or not, it's your choice. But be prepared to do it, whether it's on the liabilities, on the asset side, be prepared to be there and have a piece of every pie. Now, how much of that you wish to have is your choice. But be there and be prepared to handle any of these opportunities which emerge. The other is about corporate governance, and we can talk at length about it. But more importantly, what we have seen is having a very strong board, having a board which has seen business cycles helps. Ability to, engage with the board. In fact, what we have seen is engagement with the board at these points becomes even more deeper. Taking everybody along is extremely important, because when you're making decisions, some of them may be tricky ones. So having, the support system along with you also helps. Similarly, RBI has come around with this concept of CRO, but I think so a lot of NBFCs already had a similar structure in place. The ones which had it, which had a clearly independent risk function and an independent compliance function, have actually done well and have created a better brand for themselves in difficult times than people who did not do it. Some of these things, people don't pay importance to these things in good times, but they become extremely important in difficult times. So that's the reason I say that whether they are good times or bad times, we should ensure that our compliance structure, our risk structures are fairly independent. We have a strong board which can guide the management and even tell them if they are doing any mistakes at any point of time. Where a lot of times people falter is, on the definition of this word independent. It's like when in management we always say, do you want a lot of people in your team who think like you, or do you want a lot of people in your team who can challenge you at times? Now, the latter obviously plays far better in the long run than the former. But you have to have the right mix so that as an organization you move forward and rather than, moving on the sides. The third thing which is extremely important is to always remain focused on the customer. Because whether they are good times or bad times, and in fact more so in bad times, this becomes extremely important. The other thing which we've seen works very well is, since we are in the lending business, there will be times when the business will not be doing as well, or the current times. But do we have a stream of fee income which continues to grow and which can help us manage any difficult times? So how do you really, decrease the risk on your earnings? So these things become extremely important. Partnerships become extremely important, and we are seeing the advantage of the same in these times, whether they're partnership with banks, whether they're partnership with fintechs, and so on and so forth. The other thing about credit quality, and this is something, again, which stems from the previous slide, where do you really have an independent risk team? Do you really have an independent credit team? Because that helps you build a very strong portfolio. Do you use analytics a lot? So all of these things become extremely important, because I think any investor who puts money or is willing to put money in the entity, and especially at these points of time, they are not looking at the past growth pattern of the company, but they're looking at the quality of the portfolio. And in these difficult times, they look at whether these portfolios have behaved well or not. All portfolios which behave well in difficult times, trust me, will do extremely well in good times. The last point, and this is not really, I'm using debt management or collections as a focus on this slide, because the economy seems to be going through a difficult time, and there are a lot of sectors which seem to be stressed. At this point of time, we need to become even more vigilant. We need to tighten our credit standards, even at the cost of growth. We need to do that. But my point on this slide was that, what is going to create a differentiator for us in the future or the current times? And have we ensured that our best resources are there in those areas which will create the differentiator for us? A lot of times, the best resources in an organization go into sales. I'm not saying that's not important. But there are a lot of other functions which probably can have an even more significant impact on the earnings of the organization. And have we ensured our best resources are there in those functions? And every organization knows what those critical areas are. But more importantly, if we do that, then we are far better prepared to handle the future. The last slide, as I started off, I feel NBFCs will do extremely well. They will come back in a more stronger way, managing the current situation, and we will again see the next decade belonging to the NBFCs. And two reasons. One, because, and I think so, this is extremely critical, especially in this forum. You will find India has become the epicenter of disruption. The amount of money which is coming in early stage companies or companies which are creating a difference is much more than it's happening in other economies. And NBFCs are the ones which will, I believe, be the partners of those entities and will help create that disruption. And the second thing is, if NBFCs are bringing in more customers and to the ecosystem of credit, I feel that they have an opportunity, and not only an opportunity, but a responsibility to take India to being a 5 trillion economy. And there is no way that can happen without NBFCs playing a very, very important role. Thank you very much.